Welcome students to Finance and Module 1. In this module we are going to introduce firms and see what their objectives are from the perspective of corporate finance. This will provide an overall objective that will help guide our study through the modules that follow. Unlike many other functions in firms, such as marketing or management, we will see that this objective is very simple. It is also one that has stood the test of time for many decades and across the world. But because it is so simple, we will see that in a real-world scenario, it starts to become an increasingly complicated objective that needs adjustment to make allowance for the environment in which the firm operates and the stakeholders that have an interest in the firm. How does corporate finance fit in businesses? If we look at Apple, the company achieved great success with their products, posting billions in revenues and profits. However, behind that success, there were financial managers, analysts, risk assessors, and a whole team of people that played a crucial part in achieving that success. For example, before the iPad was launched, there was an evaluation of the potential market for such a device. An estimation was made on how much it would cost to produce an iPad, and based on that cost, an analysis was made on how many iPads would have to be sold to earn a profit. Furthermore, contingency plans were made on how to deal with potential risks of selling the product in other countries, things like political, country, and foreign exchange risk. So in this course, we look at how financial managers deal with most of these issues. In this course, we mostly talk about firms as private sector organizations. There are different advantages and disadvantages for these different types of organization, but generally we find that businesses progress through these forms as they become larger and more complex. For example, most startups and small businesses are sole proprietorships or partnerships. For such a business, the biggest advantage is that it's easier to start. It doesn't have to comply with a lot of government regulation and various specific laws. And for a sole proprietorship, the owner keeps all the profits. The disadvantage is that the business has limited life and the owners have unlimited liability. If something happens and the owners get sued, they are liable not only with the business assets, but personal assets as well, their house, car, personal bank account. With a partnership, the advantage is that there are more owners, therefore there is more capital invested. However, like the sole proprietorship, a major disadvantage is that the partners have unlimited liability. Also, it is very difficult to transfer ownership. If one partner wants to leave the business, the partnership must be dissolved first, must sell their share to the remaining partners, then everything starts again with the remaining partners. Limited partnerships are organizations where some partners have limited liabilities. In general, these partners don't get involved in the running of the day-to-day business. They are passive partners. They only contribute capital. And because of this limited liability, they get less shares in the profits. However, their benefit is that their income is taxed as partnership income. As firms grow into medium-sized businesses, they may adopt a company form, while the very largest may eventually become publicly listed companies. A proprietary limited company has between 2 and 5 shareholders. In general, these are private companies. They still must adhere to the corporation law, and they are subject to compliance and administrative costs, which can be high. For this reason, this form of business is better suited to medium-sized businesses. And then we have the company, a legal entity owned by shareholders who have limited liability. The company has the advantage of unlimited life, easy access to capital, and business diversification. Currently, there are about 2.5 million business organizations in Australia, ranging in size from small businesses owned, managed, and operated by a single individual, all the way up to large listed companies with thousands of employees and shareholders. In addition to private sector, we also have the government or public sector, which contains many organizations including federal, state, and local government departments and agencies. A residual group is the not-for-profit sector, consisting of about 600,000 organizations. These are entities established for a community purpose and do not operate in the market sector, and only a small number rely on government for funding. Importantly, while these organizations are very different to firms, many of the tools we will learn about in this course that apply to firms, they have been equally applied to not-for-profit and government decision-making. A convenient way to introduce ourselves to the financial decisions a firm makes is the balance sheet. The assets of the firm are on the left-hand side of the balance sheet. These assets are current, short-term, and non-current, which are long-term or fixed. Some non-current assets are tangible, such as machinery and equipment. Others are intangible, such as patents and trademarks. Current assets comprise assets like inventory, cash, and accounts receivable. For example, the products made by the firm but are not yet sold are part of its inventory. Generally speaking, the non-current assets are used to produce some good or service which is intended to be sold to generate revenue. The current assets are generated as part of this productive process, as raw materials, products, services for customers, etc. In finance, we refer to the decisions we make concerning non-current or productive assets as the investment decision. However, before a firm can invest in any asset, it must obtain financing, must raise the money to pay for these assets. The forms of financing are represented on the right-hand side of the balance sheet. Typically, a firm will raise funds through debt and equity. Debt is a liability to the firm, and it can be current with repayments or maturity of less than 1 year, and is considered a short-term debt, such as line of credit, overdraft, or accounts payable, or it can be non-current with a maturity or term greater than 1 year. We consider that long-term debt, such as bank loans, capital leases, and bonds. The other form of funding is equity. Equity is created with a firm and increases as new investors invest capital into the company and become shareholders. We refer to the decisions we make concerning debt and equity as the financing decision. Finally, the firm needs to make decisions about how it will return the value created to its shareholders. We refer to this as the dividend decision. So the key 3 decisions addressed in this course are an investment decision, and we use the term capital budgeting or project evaluation to describe the process of making and managing expenditures on long-lived assets. The second is the financing decision, or how can the firm raise cash for required capital expenditure. The answer to this involves the firm's capital structure, which represents the proportions of the firm's financing from current and long-term debt and equity. And the third is the dividend decision. How should a firm reward its owners? The decision whether to pay dividends or reinvest the cash into the firm is a trade-off, because the more funds are invested back in the firm, the more beneficial it will be for the shareholders in the long run. We use the concept of dividend policy to describe these questions of whether, how, and when to return cash. For convenience, we discuss this separately throughout the course, but we will soon realize they are interrelated and that a decision in one area may affect those in other areas. Regarding the investment decision, which falls under capital budgeting, Managers must be aware of certain features of the actual cash flows before deciding which assets to buy, which projects to take on, which expenditure to budget, and so on. These issues relating to cash flows involves evaluating the size, the timing, and risk of future cash flows. The size relates to how we measure the cash flows. Accounting income does not mean cash flow. For example, a sale and the cost are recorded at the time of sale and when the cost is incurred, not when the cash is exchanged. This means that what's in the books is not actually cash in hand. Timing refers to when the cash is received. $1 today is worth more than $1 at some future date. And we will see that there is a trade-off between the size of an investment's cash flow and when the cash flow is received. Risk refers to the role of the financial manager in dealing with the uncertainty associated with investment decisions. Assessing the risk of expected future cash flows is critical to investment decisions. Are the projected cash flows optimistic or pessimistic? Is there a risk that the assets will stop earning money? When dealing with the capital structure of the firm, managers must decide how to finance the assets. Is it raise all equity or a mixture of debt and equity? And if debt is involved, again, what is the best way to borrow money? Is it issue bonds to investors or go to the bank and borrow? The ultimate question is, what is the cheapest way to have debt in the firm? The managers must also deal with issues affecting the current assets and liabilities of the firm, items that have the most influence on the flow of cash. This is known as working capital management. Examples of working capital management decisions are who to sell on credit, how much inventory to carry, when to pay the suppliers, in summary, management of short-term financing needs. As we've said previously, the dividend decision is important as well, as it can influence the growth of the firm if management decides against paying dividends. Factors that need to be taken in consideration are any potential growth opportunities. Are there any new profitable projects to invest in that will make our firm better? So instead of paying dividends, it might be better to invest in other assets. The other issue is taxation. Are the dividends franked or unfranked? Will shareholders pay tax to get a credit for the tax already paid by the company? And last, the shareholders' preferences with respect of the structure of the dividend policy. For example, does the company have a dividend reinvestment plan? We will discuss this in our very last module in the course. In addition to the three main functions discussed, we add two more functions that are important in the running of the business. One of them is the risk management function, which involves identifying, measuring, and managing the firm's exposure to all types of risk. Examples of such risks are losses associated with fire damages, product liability, and loss associated with adverse changes in the interest rates, commodity prices, and currency values. The other is the corporate governance function, which involves developing company structures and incentives that promote ethical behavior and decision-making that benefit not only the shareholders, but other stakeholders as well. We will talk about this in later slides. Based on the corporate finance functions, we need to decide upon the firm's overriding objective.